Welcome to a video that I like to call the What to Watch video. Every week I do a number of videos. I do a video each day, I do a weekly video, I do an intermarket analysis video. The last video each week is called the deep dive video, where I go through a bunch of charts that I really didn't talk about all that much and other charts that are unique just to that video. Then I like to take a step back and just look at the high level things that are really talking to us right now. And this gives you an idea of what I'll be watching over the next couple of days. The idea behind this video is it's prepared on an as-needed basis. I prepared one a week ago. Things really haven't changed all that much. The one before that was about 3 weeks prior, and nothing really changed during that time. So you might see some of these videos posted quite often. Other times I may go an extended period of time without posting another What to Watch video. This is being prepared for Tuesday, February 20th. The markets will be closed on Monday, February 19th, in observance of President's Day. The first thing that I like to do is go through and list those things that are positive. Now, there's a bit of a tilt to the negative side with the positive list. Even though there are some positive things, they're showing a little bit of weakness, and those are things that we want to keep an eye on. The first one for right now is just flat out positive. The S&P is still above 5,000. We closed above that level on Friday, February 16th. And that's a positive thing. It's a real mark of achievement for the index. And we're really close to setting all-time highs, even though we're off of that right now. Our technicals are still positive when we look at all the charts together. We had been extremely overbought, looking a little too positive there. We pulled back. We had a pretty significant down day on Tuesday when CPI came in stronger than expected. We spent Wednesday and Thursday bouncing back, and that kind of kicked us more into a slightly overbought condition. But when we are in an extended uptrend like we've been in since October 2022, we can ride this overbought wave for quite a while, since the market is quite positive. Also, we keep an eye on growth to value ratios. In a good, solid environment, we want to see growth outperforming value. In a more defensive environment, value will outperform growth. We are seeing some improvement with growth outperforming, but it has been pulling back, and I have a number of different charts with different indexes to show you that. We also keep an eye on discretionary. This is what makes life fun, the things that you would like to have but don't necessarily have to have, versus staples, the things that you have to have no matter what's going on in the economy. When discretionary is outperforming staples, that tends to be more positive for the market. Also, the S&P is still in a solid uptrend, and I have a trend line to show you that. The first chart that we look at is a red line, which represents value, and a blue line, which represents growth. These are independent of each other, but they're plotted here on the same chart. We were starting to see some improvement here, where the blue line was above the red line, even though they're on different scales. But lately, we've been seeing the red line actually outperforming the blue line. They both were down in Friday's session, but when the red line goes up above, that's a little bit more negative for the market. For overall, this is still looking to show some improvement. We also look at a growth to value ratio. This is a 10-minute intraday chart. Beginning about the 31st of January, we were seeing growth outperforming value. Now we're seeing it start to level off and even decline over the past week. This is another area that is still positive for right now, but we want to watch this to see if further weakness ends up developing. Then here's a look at small cap growth versus value, and for about the last year, we've been chopping sideways in this range. We did see a breakout, and that is showing some improvement for the small caps. We're not really seeing that reflected in the index itself, but this just suggests that a lot of the smart money is in buying growth stocks that at some point could have an impact and drive the small caps higher. We did pull back a little bit later in the week, but overall, this is really showing an improvement. We also keep an eye on mid-cap growth to value. This has been in a more sustained uptrend, and it was starting to break out even though it has pulled back. We're seeing a little bit of that reflected in the index itself, where we were able to surpass this previous high. Then we look at an end-of-day S&P growth to value ratio. When we were going up with the S&P, there were some warning signs that were flashing because we saw the growth to value ratio going down, and that's pretty much what led to a lot of the sideways action. And then we kind of stalled out for a while, and then when growth started to show some improvement, that's when the S&P really kicked into gear. So overall, this is still looking better, even though we have been pulling back recently. And we keep an eye on discretionary versus staples. What I pay attention to is the ratio on the bottom. When discretionary is outperforming, this ratio goes up, and we are seeing some improvement here. But again, we did see a bit of a pullback in Friday's session. We compare that with the chart on top, which is the S&P 500. When this is going up, that tends to confirm the S&P going up as well and gives us more confidence that the uptrend can continue. And here's a trendline study. This goes from the October low set back in 2023 and then just extends through a few of these lows here. We did come down below this in Tuesday's session, but we were able to close back up off of that. If we see some weakness start to develop, the first line of defense, so to speak, is going to be this trend line. If we come down and actually close below it, that could signal to us that maybe things are turning a bit more negative. Also coinciding with that is the 20-period simple and exponential moving averages. The blue line is the exponential moving average, and it moves faster. It's weighted more towards current prices. The red line is a simple moving average where all periods are treated the same. This did act as support when we were having a downturn in this past week. If we break below the trend line and then come down, this would be the next logical level of support. If we break below that, we might end up heading towards the 50-day moving average. Then we look at some things that are more negative for right now. The first thing is that sentiment is extreme positive. Now, the idea that everybody's happy, isn't that a good thing? Well, you can get a little too happy. And when the market gets a little too exuberant, we look at using that as a contrarian indicator. Also, the Parabolic SAR. This is one of the more important indicators that I've relied on for a long time. It had been positive this past week. It's now switched over to negative. I have a 200 period and a 50 period simple moving average study that is continuing to negatively diverge from the S&P 500. Also, the transports in a little bit bigger picture, they're also negatively diverging from not only the Dow, but also the S&P 500. Small caps continue to underperform, but we might be seeing some signs of improvement there. The dollar continues to rebound, and when that's going up, that can quite often put pressure on stocks. We also are entering a period of time, about the middle of February to the middle to latter part of March, where we do see some historical weakness, and we'll have to see, is it going to play out that way this time? The first chart is the Fear and Greed Index put out by CNN Money, and we're above this 75 level. Now, we could go higher than this, but when we get to the 75 level, this is when we want to start looking at, okay, maybe folks are getting a little too happy about things, because other times you can see when we got above the 75 level, that often led to a decline, and this is going down as stocks are also going down. This is the Parabolic SAR system. SAR means stop and reversal. When the dots are underneath, that means that we're positive, and we've been positive here for quite a while. But in the past week, we saw the dots switch, and now they're on top, and this is more intermediate term negative. Also, we're seeing that longer term negative divergence between the Dow, which is really close to setting all-time highs, but the transports are really lagging behind. I was consulting some different information sources this past week, looking at other transport indexes and other industry groups in the transportation indexes, and those are showing some signs of improvement, but we're just not seeing that carrying through to the Dow transports for right now. In fact, we saw some weakness develop over this past week in the transports. We look at a longer-term chart of the transports where we had been breaking out above this previous high set in late 2023. Now we're starting to fall back. We still need to get back to this other high set in 2023, let alone the all-time high, which was set back in late 2021. If we can do that, if this can turn and start to go back up, that would confirm the all-time highs that we're seeing in the Dow. Then we look at a ratio between the transports and the S&P. When this is going down, that means the transports are underperforming, and that's what we're seeing right now. There's really some follow-through weakness here. And we look at a ratio between the small caps and the S&P 500. For most of 2023, the small caps were underperforming as the mega caps were outperforming. We did see a bounce in late December, but then once we hit 2024, this ratio started to go back down, but we have been bouncing back up. But we need to see more follow through to the upside to turn more positive with this ratio. And we look at the dollar where it's still in a longer term downtrend. We see the blue line is below the red line with the moving averages, But the longer we stay above those lines, the more we might see a golden cross here. We got down to the 100 level just before the end of 2023, and as this was going down, that was giving support to stocks. Now that this is going back up, that could put some pressure on stocks. We also keep an eye on a VIX to S&P 500 correlation, and that's what's measured in the middle. When this is getting to a really high reading, typically, if you see the other areas that I marked, we would spike and then start to come back down. That was typically short to intermediate term negative for the S&P. We'll have to see if it works out that way. We don't know right now if this is actually topped out. It could go higher than it has. We spiked up, came down, spiked up, came down, and then in Friday's session came back up. We'll have to see, is this going to end up going higher or is this going to fall? And then will that trigger some kind of a signal that, as I said, can quite often be negative? We also look at a thing called the skew index, which is closely related to the VIX. The VIX looks at the money options to do its calculations, where the skew index looks at out of the money options. When we get up into this red area, the market is expecting some kind of a big move. Now you can see other times when we spiked and then started to come down, sometimes that marked the top, sometimes it marked the bottom, sometimes it was just a continuation. Looking at the context of everything together, if this continues to drop down and actually has already put in its spike, that could end up being negative for the market. And then looking at seasonality, this is put out by Carson, where it says late February can be tricky for the bulls. We're in the middle part of February now going forward, where we historically do see some weakness. Now, we don't know if it's actually going to play out that way this time, but when you take the years 1950 to 2023, that is what has happened in the past. Here's a longer look where we also see this not only continuing to the end of February, we might see a little bit of a bounce in March and then some more seasonal weakness going into the middle to latter part of March. The strength that we might see during an election year that we often do experience, that tends to come after we see this period of weakness historically. Then here's another look at that when the sitting president is running for re-election. We tend to start off well with the green line, and then about the middle part or so of February, that's when we see some weakness going into the middle to latter part of March. So we have a number of different charts looking at this a number of different ways, suggesting that we might be entering a period of seasonal weakness. Tom Bowley has also done some research based on this. He's connected with stockcharts.com and another site called earningsbeats.com. And he sends out a free email. And this says that for February, his research has concluded that it's a bearish month, where we pretty much have now passed the times in February that are positive. And going forward from here, we tend to see negative seasonality. Thank you. I really hope you found this helpful. Please feel free to check out some of the other videos that I also post. I hope you have a really great week, and I will talk to you in the next video.